Let's hit recording. Alrighty, so like I mentioned, this was dropped in the chat. I just dropped it in all the chats, the DeFi, the Cypress analysis, and the general chat. So let's just scroll down to the bottom of this and we'll start with crypto. So today, the cryptocurrency market has experienced a 3.5% increase. In my personal opinion, this is primarily because the market makers are starting to price in a more dovish perspective from the Federal Reserve, i.e., remember like mid-year, towards the beginning of the year, the rate cut sentiment started to dwindle. We started to see higher inflation. We started to see upbeat US data. That sentiment has now relatively changed, where we're starting to see disinflation come into fruition and we're starting to see dwindling or weaker economic data, especially with the horrible NFP reports that we got last week or the week prior. That has all changed the perspective of the rate cut differential from the Federal Reserve, where now the market's starting to price in possible 2 to 3 rate cuts before the end of this year, whereas prior in the middle of this year, or like Q2 roughly, when the market was pulling back from that $2.7 trillion threshold up until where we currently sit now, the market was only pricing in 1 to 2 rate cuts. Okay. So that's why I believe the market's turning around. Obviously, of course, there's been no new fear, uncertainty, and doubt pumped into the market, and we saw some profit taking on safe haven assets like the yen and gold and Swiss franc, right? So roughly around $7 billion in total cryptocurrency market cap has increased today, which now hovers around 2 to $2.1 trillion, or that historical threshold since the beginning of this year that we've seen hold weight. So the market remains in a holding pattern for now, awaiting further data to determine where market makers will push price next. Our primary focus this week for crypto will continue to be on central bank positions. Currently, the market is leaning towards the possibility, like I mentioned, of 2 to 3 rate cuts from the Federal Reserve. So, as participants in this space, we need to pay attention to if that sentiment changes. If that's the current sentiment right now that is allowed for cryptocurrency assets across the board to recover, if that sentiment changes, right, and we start to see higher CPI, higher PPI readings from the US showing signs of sticky and troublesome inflation, weighing on that rate cut narrative, any upbeat, optimistic data that drives more strength for the dollar and weighs on that rate cut narrative, then those are all things that could change this current sentiment and that could weigh on cryptocurrency prices. So I mentioned, however, this outlook could shift if we see persistent inflation coupled with stronger US economic data this week. The market is also on a standby phase, awaiting further developments in the geopolitical forefront, especially as tensions in the Middle East have shown no signs of cooling. We've seen consistent headlines breaking over the past couple of months, where more recently, over the past consecutive couple of weeks, we are waiting on standby to see if Iran retaliates against Israel because of the recent assassination and whatnot, and they have constantly been touting out that they are going to retaliate. We just don't know when. Every single week so far since the assassination, they've been saying that it's going to be this week, it's going to be this week, it's going to be this week. So, in my personal opinion, again, this is just something to pay attention to because if they do decide to retaliate and tensions do escalate or more parties get involved, we know that increased fear, uncertainty, and doubt on the geopolitical forefront to some degree, even if it's just a quick shock to the downside, does usually tend to weigh on risk assets. So overall, these two factors are critical because in the first week of August, a dismal jobs report, i.e. a downbeat NFP report, sparked recessionary fears on a global forefront, and escalating Middle East tensions were key factors that weighed on the price of crypto assets across the board. So monitoring these developments closely is essential moving forward. Another significant factor that impacted risk assets like crypto was the recent interest rate hike by the Bank of Japan and the subsequent unwinding of yen carry trades, which we have detailed in previous reports. So if you guys are new or hearing that for the first time, make sure that you go back and you watch previous Zoom calls or you just read some of the previous fundamental reports where we broke this down in detail. Currently, a former Bank of Japan official, I want you all to pay attention to those key vocabulary, a former, not a current, so this is still just an opinion, has indicated that the central bank is likely to defer any further interest rate hikes until next year, which would be positive for risk assets. Okay. So This individual, this former Bank of Japan representative, I was reading a report from I think it was the LSEG. They won't be able to hike again, at least for the rest of the year, said Makoto Sakari, according to a Bloomberg report. It's a toss-up whether they can do one rate hike by next year in March. So obviously, of course, if the Bank of Japan does not hike rates any further the remainder of this year or heading into next year, that would allow for, again, a more optimistic view on risk assets like crypto and stocks. Okay. The Bank of Japan raised its key interest rate around 0.25% from near zero on July 31st. This is the most recent update, marking the first increase in over a decade. This shift away from near zero interest rate policy pushed the yen higher, triggering an unwinding of risk on yen carry trades. The resulting slide in traditional risk assets heavily impacted Bitcoin, causing it to drop approximately from 65,000 to 50,000 in less than a week, which we all got to experience firsthand. So we will continue to monitor any developments or changes in the Bank of Japan's monetary policy stance as further tightening, this is the most important part, as further tightening could increase demand for the yen while reducing demand for risk assets like stocks and crypto. So that means this week we have some inflationary figures and some data on the Japanese front that I mentioned to you guys in previous breakdowns. Make sure that you go read the bottom of those. And I go on to talk about how if we see higher inflation readings, sorry, excuse me. Yeah, excuse me. Yeah, if we see higher inflation readings on the Japanese front or any upbeat data, this would most likely prompt the Bank of Japan to consider hiking rates. So we just need to pay attention to that. And if the market starts to price that in, or if we do see another rate hike by the Bank of Japan, which I don't think is going to happen because of how freaking chaotic it made the markets last week, and Bank of Japan representatives and finance ministers said that they don't want that to happen in the market. Um, but we know now that it could have a negative implication for risk assets. So if we do see something like that unfold, again, the reason why it's important to pay attention to it is because we know how to react. We know that if we do see, for example, let's just take a look back at the total cryptocurrency market cap, you have plenty of time to react. What do I mean by that? We can see that on July 31st, this is when the Bank of Japan hiked rates, right? So in the future, I mean, think about this, right? July 31st is when they hiked rates here in this area. We had 4 days, relatively speaking, to pull some profits before the market tanked significantly. So the reason why I'm trying to get you guys to see this is so that way we can start to play chess, not checkers, with our positions in this market, where if we do see another rate hike by the Bank of Japan, it might not negatively affect price action on the exact day, but we know that over a course of the next days to follow, that it could weigh on price action, right? So if you're in buy positions, or if you're in longs, or if you're in dollar cost average positions that are in significant profit, you could start to consider taking some profit off the table. I'm trying to get you guys to see that in order to make money in this market, you're going to need to learn these things, because to make money, you have to pull profit. Well, if you don't know how to pull profit or why to pull profit, right, then you're never going to make money. So that's why I'm trying to get you guys to see these fundamental factors and why they're important. So overall, 3 factors to pay attention to this week for risk assets across the board. Obviously, of course, there's many others to pay attention to, but these are the 3 main ones: Middle East tensions, central bank policy positioning, and the yen strength or weakness. Okay. So crypto, relatively speaking, out of the way, there's no real updates. Markets kind of just ranging sideways. Over Saturday, we were above 2 trillion, and then just recently on Sunday, we dipped below, and right now we're still currently hovering, awaiting further market movement. If we do break above 2.1 trillion, we see an improved market sentiment. We could possibly start to recover back towards 2.3 to 2.4 trillion, maybe turn this into an accumulation schematic and start to see a breakout back up into these highs. However, if we see a worsening market sentiment and we see risk assets start to sell off, you guys know that my overall bearish targets is to come back down here and attack these January 2024 lows at roughly around 1.5 to 1.4 trillion. All right. If we do come down here and liquidate these lows, I think that that would be the last market sell-off, because from my personal perspective, what I've seen is that year on end, if market makers push prices down into a year on end low, that's where they come and they'll equal out all these open orders that exist down here. They'll start to reaccumulate orders underneath of those lows. Everybody will be fearful, and that's when they will be buying up price to push it higher. So if we do see that unfold, don't be fearful. Just look at that as an opportunity. However, it's not guaranteed. Okay. So crypto out of the way. Just a real quick update. We know now what to be paying attention to this week. All right, so let's jump down the rabbit hole on GBP USD and give you guys my overall price targets and projections, but I really want to break this week's fundamentals down for you guys from an FX standpoint and what to be paying attention to. So I wrote this out for you guys, typed it out, and tried to make it as clear as possible. So hopefully the way that I break this down, there aren't too many questions after, and you guys clearly understand the divergence between the central banks. All right. So let's start to attack this. Can you guys see this font from the recording so that way you can pay attention? Let me try and zoom in a little bit. I know that it might be small because you guys are on my big monitor.
Oh no, it's clear, yeah.
All right. Okay. All right. So GBP USD holds steady in the early North American trading session. It was up today about 0.6%. Sorry, excuse me, 0.06% at roughly around 1.2765 as traders are currently awaiting crucial UK employment data on Tuesday and US CPI figures on Wednesday. The reason why I wrote US CPI figures and not PPI and CPI, which we'll go over in this breakdown, is because PPI is less important than CPI, albeit they're both relatively important, but CPI takes precedence over PPI. So just remember that. The reason why I try to get you guys to see that is because remember, we don't need to be in the markets every single day. We want to be paying attention to those key fundamental factors that are going to give us the most volume and volatility in the market. So if we know tomorrow's PPI for the US front, but then Wednesday is CPI, which day should we try to lean more so towards risking and exposing our capital in the market to get that one-sided data? We know PPI is less important or moves the market less impactful than CPI. We should wait till Wednesday. At least that's my strategy. Remember, the less that you expose your capital in this market, the better off you are. Okay. So we'll be looking for these crucial fundamental data points, the UK employment data and the US inflation for insights into central bank policy direction. If these data points suggest stable inflation in the UK, it could propel GBP USD higher. Although the Bank of England has been ahead of the Fed cutting rates since August 1st, which we just recently saw. The Bank of England did usher in rate cuts. The futures markets right now continue to price in a less dovish stance from the Bank of England compared to the Fed for the rest of 2024 into 2025. That's why we're seeing a slight bullish turnaround in GBP USD as of right now. The market bottomed out at roughly around 1.27 flat, which we called out last week. But this is primarily because as of right now, market makers are starting to price in that the Federal Reserve is going to cut rates at a much more rapid pace than the Bank of England. All right, so let's try to break this down. So I said to you guys, according to the LSEG's IRPR page, it's a report from a bank, an institution that writes out these reports. The Bank of England is expected to reduce rates by a further 43 basis points by year end 2024, totaling 68 basis point cuts for the year. In contrast, the Fed is projected to cut 101 basis points during the same time period. This will most likely provide support for the Great British Pound moving forward if this scenario unfolds. Okay, let me mute for you guys. So let's break this down. Let's really get to understand this interest rate differential, and why, if the Bank of England cuts rates by 68 basis points and the Fed cuts rates by 101 basis points, why this would most likely support the Great British Pound over the dollar. All right, so I wrote, let's break this down in detail. The projected rate cuts by the Bank of England and the Fed create central bank divergence. Write that down. If you guys don't have that key vocabulary word terminology embedded into your brain, that's extremely important. I'll give you guys an example. GBP JPY. Over the past consecutive couple of years, let's just say it's been a long time, right? It's been a very long time. If you go look at GBP JPY on the higher time frame, just as an example, GBP JPY has been predominantly bullish, right? Why is this? It's because of central bank policy divergence, okay, where over the past consecutive couple of years, the Bank of England has maintained a more hawkish monetary policy stance, tightening monetary policy, right? Limiting money supply in the market, where vice versa, the Bank of Japan has been easing monetary policy, stimulating the economy, buying up Japanese government bonds, pumping, quantitatively easing the economy, pumping Japanese yen into the market, which obviously, of course, diminishes the currency value. And this has created a more of a demand for the Great British Pound and less of a demand for the Japanese yen. Whereas most recently, you guys can see the sell pressure that took place in the market. This is because of the policy divergence, where the Bank of England most recently cut interest rates, right? And the Bank of Japan actually hiked interest rates. And you can see the effect that that had on the market. We pulled back almost, let's say, over 2,000 pips, well over 2,000 pips, almost 3,000 pips, right? That's insane. And that all happened because of the shift in monetary policy for the first time in years, right? And it's possible that that's set to continue. So I'm just trying to show you guys why it's important to pay attention to this stuff. This is GBP JPY, but now looking at GBP USD, we're on the precipice of experiencing the same thing, where this policy divergence is what's going to be driving sentiment in the price valuation of these currency pairs that we're trading. So this can impact currency strength and investor behavior in several different ways. Number one, central bank divergence. Bank of England versus the Fed. The Bank of England is expected to cut rates by 68 basis points by the end of 2024 as of right now. Remember, that could possibly change, but that is what's being said amongst market participants and what's being priced in by market makers. While the Fed is projected to cut by a more aggressive 101 basis points. This difference in the pace and extent of rate cuts between the two central banks is known as central bank divergence. The impact that it has on currency strength. Relative interest rates. Currencies often strengthen when their central bank is perceived to be less dovish, that means more hawkish, less inclined to cut rates compared to other central banks. In this scenario, while both the Bank of England and the Fed are cutting rates, the Bank of England's smaller rate cut at 68 basis points compared to the Fed's larger rate cut at 100 basis points suggests that the Bank of England is less aggressive in easing monetary policy. This, therefore, makes the Great British Pound relatively more attractive than the US dollar. Okay, that's as of right now. Investor behavior and capital allocation. Shifting capital flows. As investors seek higher returns, they are likely to shift their capital towards currencies, in this case, the Great British Pound, associated with less aggressive rate cuts. In this case, again, the Great British Pound. This capital inflow into the UK could increase the demand for the Great British Pound, which would therefore drive up its value. Risk perception. Investors may also perceive the Bank of England less dovish stance as a signal of greater confidence in the UK economy, because what would need to happen for this environment to unfold? We would need to see upbeat labor market figures from the UK. We would need to see higher inflation readings from the UK. All of these things show a relative resilient and stronger UK economy, which again, therefore drives or tends to drive demand for said domestic currency. Compared to the US economy, which we've just most recently seen via the labor market report that we got at the beginning of the month, with the NFP report coming out super horrible. Okay. So if the US economy is performing horrible, inflation's coming down, it's leaning more so towards that the Federal Reserve is going to cut interest rates faster than the Bank of England, whereas vice versa, over on the UK side of things, the economy is performing better, inflation is still sticky and troublesome, well above the central bank target, where the central bank is going to have to lean more so towards keeping interest rates higher for longer. Where are investors going to want to hold and allocate their capital? They're going to want to have their capital in the Great British Pound, right? So are you guys kind of starting to see, as I'm breaking this down, why this is important? So supporting the Great British Pound. Higher yield and confidence. The combination of a higher relative yield and investor confidence can bolster the Great British Pound. Even though both central banks are cutting rates, the smaller cut by the Bank of England implies that the UK economy might not require as much monetary stimulus as the US economy, which could be interpreted as a sign of relative economic strength. So, in summary, the divergence in the pace of rate cuts between the Bank of England and the Fed could lead to a stronger Great British Pound as investors seek to allocate capital to a currency with relatively higher yields and potentially stronger economic fundamentals. So, what do we need to be paying attention to this week before we move on for the rest of this document? If you haven't read it already, or if you have, what two factors are on the next data forefront that we need to pay attention to for the UK and the US tomorrow and tonight during London session? Can anybody tell me? What two fundamental factors are upcoming that we should be paying attention to on the UK front and the US front?
CPI?
On the UK, go
Okay.
ahead.
Shout them out.
Can I answer?
Yeah, go ahead.
Yeah.
Okay, so Tuesday for the UK, there are claim and count change and PPI inflation for USD. So
Yep, perfect. That's it. Right. So the climate count change, remember, is similar to the US NFP report, where it's
yes,
a report on the UK front that shows you guys can see it right here. It shows the strength of the UK labor market. So we have the climate count change and the unemployment rate that's set to come out tonight here in the United States during London session, my time 11 p.m. For you UK traders or individuals across the world, that's going to be 7 a.m. UK time. And this report is going to show the strength of the UK labor market. So if this report comes out stronger or shows signs of resiliency and strength in the UK economy, right? Or sorry, the UK labor market, whereas vice versa, last week the NFP report came out super horrible for the US, where are investors most likely going to want to hold their capital? In the Great British Pound, right? Vice versa, if this data comes out downbeat, if this data shows signs of higher unemployments, if this data shows signs of less people employed, right? That's going to show signs of weakness in the UK labor market. That's going to create uncertainty in the UK economy, and it's going to incline investors to not want to hold their assets denominated in Great British pounds. Does that make sense? So they're going to want to sell. So understanding these things is extremely important. We'll break this down in just 1 second. And then Abidwa mentioned as well, following that New York session Tuesday morning, so that's tomorrow, we have the CPI report. Sorry, excuse me. We have the CPI report 11 p.m. tomorrow. So again, that's going to be Wednesday morning actually for you UK traders, but for us here on the US front, it'll be 11 p.m. tomorrow. But during the United States session, we have the core PPI month over month, right? As of right now, that data set to come out mixed, but like the market's pricing in, right now the market is pricing in that on the US front, disinflation is going to continue, right? So if disinflation continues, that means inflation comes out at previous readings or below previous readings. That is going to support the rate cut narrative from the Federal Reserve, which is what the market is pricing in right now. I just read to you guys, right? The market right now is pricing in about 101 basis point rate cuts from the Federal Reserve. So in order for that to maintain the overall market sentiment, we would need to see disinflation continue. That means lower PPI readings and lower CPI readings for that to hold weight, right? And if that holds weight, where we see tomorrow's UK economy, the labor market force in the UK strengthening, coupled with lower inflation readings from the US, then this scenario, the first scenario that I have for you guys, drawn up on the breakdown, is most likely what's going to come into fruition. We're most likely going to see bulls continue on GBP USD as investors shy away from the dollar and invest in the Great British Pound. Right? And we'll break this down in full in just 1 second. Inversely, if we see downbeat UK labor market figures, lower inflation from the UK front, and higher inflation on the US front, that's going to create more of a demand for the dollar and less of a demand for the Great British pound. And this scenario would most likely unfold, where the Great British pound fails to break previous highs, starts to reverse traction, and possibly break below the 1.27 or this previous low that we just created, and start to seek lower targets as investors buy the dollar and sell the Great British pound, right? So I wrote this and broke this down for you guys in detail. So should the UK employment or CPI data come in weaker than expected, support is likely at the recent low of the 1.2666 and the June 27th low of the 1.2613. On the other hand, the data pointing to persistent inflation could encourage sterling bulls, that's GBP USD bulls, to target the 2024 high of the 1.3044 that was set on July 17th. So our immediate focus is going to be on key UK labor market figures, particularly in the unemployment rate and the climate count change. Currently, the climate count change is projected to show signs of a resilient UK labor market. If the unemployment rate comes in at 4.4% or lower, coupled with a climate count change of 14.5 thousand compared to the previous reading at 32.3 thousand, it would indicate a positive shift. This decrease would suggest the following: reduced unemployment claims, a drop of 32.3 thousand to 14.5 thousand indicates fewer people are claiming unemployment benefits, possibly due to increased employment or fewer layoffs, which signal potential job market improvement, which you can see right now, that's what the market's pricing in. Here's the previous reading, 32.3 thousand, and the market's projecting that that number set to come out lower at 14.5 thousand. This shows signs of a stronger UK labor market. Inversely, if this data were to come out higher than the forecast or higher than the previous reading, that would signal signs of weakness in the UK labor market, right? Does that make sense? Moving on. Strengthening labor market. A lower climate count change typically reflects a strengthening in the labor market with more job opportunities and increased economic absorption of workers. Economic confidence. The decline may also indicate growing confidence in the UK economy, which leads to more hiring and fewer job losses. So this would be scenario number one. If we see that unfold, that means healthy UK labor market data, persistent UK inflation, that means inflation higher or at previous readings, lower US PPI and CPI readings, a weaker dollar below the 104.2 or the 103.8. In my personal opinion, GBP USD bulls are going to target the highs back from July. That means this scenario unfolding, where I personally will be looking for buys if we can come back down into the 1.27 flat or come and scoop the early buyers from these lows, looking for some type of reversal from these areas of interest here with a stop loss beneath these previous lows to look for higher targets, or a break above where we're currently sitting at now and breakout buys above the most recent highs to look for higher targets. This will be the predominant scenario that I will be looking for this week. And what will take to get there is this first scenario. The second scenario would be the inverse of what I just mentioned, which would be weaker than expected UK employment and CPI data, showing signs of a weaker UK labor market, that inflation is coming down to the overall goal and mandate of the Bank of England, which means that they can cut rates faster or more than what the market is pricing in right now at 68 basis points. Inversely, over on the US front, we would need to see higher US PPI and CPI data, signaling sticky and troublesome inflation on the US front, which would lead to this sentiment right now in the market changing, right? So remember that right now the market is pricing in 68 basis points from the Bank of England and 101 basis points from the Federal Reserve. So if instead we see lower inflation from the Bank of England and higher inflation on the US front, this is probably going to change. With the market, if we see higher US inflation, is probably not going to price in 101 basis point rate cuts from the Fed anymore. So this divergence that's been creating some support for the Great British Pound will most likely change as market makers start to price in either a similar rate cut scenario or a rate cut differential via the Fed and the Bank of England. Couple that with a stronger dollar, well above the 103.8, heading back towards or above the 104 key cycle levels. We're most likely going to start to see GBP USD turn around, start to target the lows of the 1.27, possibly even breaking back down into the previous lows from back in June and July at the 1.6250 flat. Looking at bearish targets anywhere below the 1.26 flat or below. All right. So you guys have these scenarios typed out. If this was confusing to you, just go back through, take your time and read this report. I tried to break it down as clear as possible on why it's important to understand this divergence and how to understand it, why the divergence between the two central banks is driving more demand for the Great British Pound right now, and what scenarios could possibly change that. All right. So hopefully this helps. Hopefully the way that I'm breaking this stuff down for you guys, it's kind of getting you to see why it's important to pay attention to this stuff. So for now, we know what to pay attention to for this week for crypto, specifically for GBP USD, we know what to pay attention to. And right, again, we're just on standby. Every single day, make sure that you're being data dependent, make sure that you're not marrying a bias. Don't trade if you are a day trader before the fundamentals. Wait for price action to unfold after the fundamentals. Look for time increments and price setups in 15-minute intervals. All right. Any questions from this particular breakdown on these topics that we covered today? Any feedback you guys want to give me on how I make this clear or how I could make this clearer? Alrighty. Blessings to you guys. I'll see you guys on tomorrow's call. We'll do a market wrap up after all this data comes out, and then we'll do a forward-looking projection as we wait for Wednesday's data.
Thanks again. Have a nice
Thank
day.
you.
Sounds good. Thanks,
Thank you.
Cypress.
You guys take it easy.
Nice.
You too, bro.